Hey there, it's Josh Lewis, Certified Mortgage Consultant with Bywise Mortgage. As you're getting ready to prepare your 2018 taxes here at the beginning of 2019, a couple of reminders. So if you're doing the taxes yourself, these are important for you to know. If you're using a tax professional, they're probably pretty well aware of it, but wanted to let you know what the two big changes are that we saw last year. The first one is that mortgage interest is only deductible on the first $750,000 of mortgage. So if you took out your loan prior to 2018, prior to the changes taking effect in late 2017, you're not impacted by this. So previously you could borrow or you could deduct interest paid on up to $1 million of mortgage debt. So as long as your loan was taken out prior to December of 2017 and you have a loan between $750,000 and $1 million, that won't impact you. For the majority of our borrowers, loan amounts smaller than $750,000, no change. All of your mortgage interest is totally tax deductible. For those of you who have smaller loans, 250, 300, 350, for most people now, you need to be above about $300,000 to make it worthwhile for the trouble of itemizing, definitely for a married couple. Single, so what happened is the standard deductions doubled last year, and with the doubled standard deduction, you need to be above $300,000 or so at current interest rates to make it make sense. So you may want to look at that if you have a smaller loan, you're married, it may make more sense to just not itemize and go with the simplified return this year. So the second thing that changed for us in California and many other high tax states, so we have high property taxes, high state income taxes. So on your federal taxes, we've always been able to deduct your state income taxes and your property taxes in full. This year that will no longer be the case. There's a $10,000 limit on state and local taxes. They call it the SALT deduction. It is capped at $10,000. So let's say in 2018 you bought a $500,000 house. You're probably paying in the ballpark of $6,000 to $7,000 of property taxes. So if your income taxes, your state income taxes were over $3,000, which they most likely are, you're going to have a limitation there. You will have a smaller tax deduction. You may have seen some of the headlines that are warning people, especially in high tax states like California, that you're going to see a smaller tax return or tax refund this year. That could be the case, and that could be one of the reasons, because we're going to be limited. For most people in California, if you get above, I think the number is about $70,000 or $80,000 in total income, you're paying 9% on that top marginal level. So most people are paying $6,000, $7,000, $8,000, $10,000, $15,000 in state taxes. And then you add in your property taxes of being $6,000 to $10,000. We're going to be losing a large amount of deductions. So if you have any questions about this and you'd like to talk about it, feel free to give me a call, shoot me an email. If your tax preparer has any questions and wants to go through it, we would love to talk with them. And as always, if you have any friends that are going through this situation, either borrowing or have questions about their tax ramifications of their current mortgage, we would love to talk to them. So we'd love to count on you to send those folks our way if you know of someone with questions or looking to buy or borrow against their current property. All right. Thanks for taking the time to watch, and we look forward to talking with you soon.